Money used to remember. It remembered scarcity. It remembered failure. It remembered exactly what happened the last time someone took too much risk. Today, it doesn't. Right now, money moves through the system like it has amnesia. Crashes arrive, panic spikes, headlines scream, and then, almost on cue, prices recover. Faster than wages, faster than trust, faster than lessons. That isn't confidence, it's conditioning. And this matters now because the global financial system has never been this large, this leveraged, or this dependent on smooth outcomes, yet it behaves like consequences are optional. For most of history, money had memory because losses stuck. If you failed, capital vanished, banks pulled back, credit tightened, risk wasn't debated, it was punished. That punishment was the memory. It taught restraint without speeches or regulators. Do this again and you don't survive. Then the world changed. Financial systems grew more interconnected. Crises stopped being local and started going global. A failure in one place threatened everything else. So the response evolved. In the late 20th century, central banks learned a powerful lesson. You can slow panic by acting early. You can soften crashes by supplying liquidity. You can replace fear with reassurance fast. Lower rates, emergency lending, backstops for markets that were too important to fail loudly. At first, it worked beautifully. After each crisis, the tools got sharper, interventions got faster, and recoveries got smoother, at least on the surface. But something subtle changed. If markets remembered pain, they hesitated. If they hesitated, growth slowed. If growth slowed, leaders panicked. So memory itself became the threat. Here's how the system works now. When something breaks, money shows up. Losses are diluted. Prices stabilize. Balance sheets heal faster than behavior. The signal that once said, "Don't do that again," still exists. It's just quieter, sometimes barely audible. Publicly, this is sold as stability, resilience, a smarter system that learned from the past. Privately, it's insulation. The uncomfortable math is simple. When downside is capped, risk doesn't disappear. It migrates. It stretches across time. It compounds where no one is looking. Debt doesn't clear. It rolls forward. Asset prices don't reset. They restart from higher levels. Every cycle begins closer to the edge than the last one did, but it feels safer because the last fall didn't hurt much. There's an irony here. Markets celebrate resilience, but resilience without memory isn't strength. It's repetition with better lighting. Volatility gets suppressed, failures get managed, and fragility builds quietly underneath. The system looks calm because it forgets quickly, but forgetting isn't the same as healing. It's postponement with a good public relations team. History usually doesn't announce when memory comes back. It waits. It lets confidence overstay its welcome, and then it collects everything at once. So here's the question we rarely ask out loud. If money no longer remembers mistakes, if the system is designed to forget pain as fast as possible, when memory finally returns, who will be expected to remember it for us?